Good afternoon, everybody. Welcome to Trader Merlin Show for your Tuesday edition. Yeah, sorry, on Friday, I meant to mention that I said it earlier last week that I was going to be gone on Monday up in LA doing a photo shoot, and I forgot to bring it up because I said, I'll see you Monday. And so I posted on Twitter, or X, whatever, that I was going to be not having a show yesterday, but we'll have Scott McCormick here in just a second. We're going to have John Rowland on Thursday. Yeah, we got a bunch of great shows. Guests abound. So let's talk about what happened up in LA. It's weird. I drove to Los Angeles with some people, and I was really surprised. I have to say I was shocked because what I've been seeing has been absolute apocalyptic. And I was in Westwood at the Westwood Trading Academy office, and not only did we not smell smoke, I didn't see smoke. I didn't see any fire. I saw absolutely nothing that would make me believe there was even a fire in the area. It was so weird. I was like, okay, let's just keep driving because I know it can't be made up. It was just so bizarre to be in LA. Maybe the wind was just blowing against us. And anyway, we did a great photo shoot yesterday. Got a whole bunch of graphics and visuals. We posted one for you yesterday, and there we go. We're going to do something a little bit different. Scott is coming on today. You guys may know Scott McCormick, one of my longtime colleagues at Trading Academy, chartered market technician, a self-proclaimed nerd, but I'm a nerd as well, so that's why we get along so well. And since it's the first month of January, we'll probably do a lot of thoughts about what the year may present. Of course, it's just an opinion. It's thoughts about our markets. None of this is investment advice. It's just ideas. So without further ado, joining me from the great state of Tejas, got Mr. Scott McCormick joining us. Scott, how you doing?
Doing fantastic. How are you?
Fantastic. Any better, I'd be twins. Oh, I got to find a new line. That one's getting a little worn out.
It's very Wall Street of you.
Yeah. How's things down in Texas doing? Better than out here on the Southern California coast?
We actually had a quote unquote winter storm last week. So kind of kept us locked up for a couple of days, but nothing too crazy.
Oh, good.
So,
well,
yeah.
Hope it stays mellow for you.
Yeah.
As we wound out last year, we had, a pretty exciting year, very elevated, another 20+% year to the upside. And of course, we'll get your forecasts and thoughts are on that at the end of the show today when we talk about your forecast for what you think the S&P will be. I'll start with what are any of your big takeaways or kind of aha moments that you gleaned from last year? Is there anything that stood out to you as wow, either I did not see that coming or something that surprised you?
I can't really say that there was. Every month, and I I know a lot of your listeners are probably regular listeners of mine as well, but we've been hosting what we call the monthly market overview, which for the most part is an abridged version of the Beck report, where we go through and we look at bonds, equities, commodities, and currencies, and try to get a sense as to where we might be within the overall market and economic cycle. And one thing that did kind of stand out was that we were kind of hopping back and forth between different stages, and most of which throughout the course of the year was still fairly bullish. Going into December, there was some warning sign that maybe we're going into stage 4, which is like a late economic and market expansion. And, we did one here just this past Wednesday, and we did a full version. So it was like a full 3-hour presentation that I gave. And it's one of the first times where the look back period that I do is a 12, 6, and a 3-month period where I saw that bonds were all indicating a stage 4. And so it's kind of interesting to kind of see the expansion of the market from the bear market lows there in late October 2022, and almost to the dollar, I'll say, on the S&P cash index in terms of our forecast last year. So we nicely met measured move targets for not only the S&P, but also the Dow, the NASDAQ, and even the Russell 2000. It finally broke out through some of the consolidation that it had been in for almost 18 months before kind of revisiting the highs there from November of 2021. And so it was nice to actually see all of those targets come to fruition, because throughout the course of the year, it's like any time you give these types of forecasts and it's like, okay, well, where do you think the market's going to go? The sarcastic part of my brain says, well, it's going to go up, down, and sideways. But you give these forecasts, and you don't know necessarily, you don't necessarily know like what are going to be the exact catalysts that will get the market there, but it just ends up getting there sometimes. And I think for me, that's the kind of surprising part sometimes, is that regardless of what's happening in the news, regardless of fundamentals, sometimes the market will still go to these targets, and it's amazing.
Yeah. Real quick before we get too lost in conversation, what maybe real quickly explain your stages, because Steve was like, hey, what's stage for, bullish or bearish? Let's walk through the stages, so because I think you're going to reference them throughout today.
Yeah, as a matter of fact, I can probably do one better. I didn't think about bringing this up before hopping on here. So if your audience bears with me here for a second, I'll go ahead and share the screen with you guys. If you can confirm that you can see that. All right, cool. So this is a cycle that we had to study in the CMT program, and this is courtesy of Martin Pring, who was one of the many that we had to study. And basically what this diagram is showing is that different asset classes will tend to show certain behavior during different stages of an economic cycle. As you can see here, you've got the various stages, from 1 through 6. So when I say a stage 4 is just indicating that you're in the not the final expansion of the economic cycle, but certainly in the late stages of it. And part of that process is that as we generally go through an economic cycle, we have various forces that will influence these cycles. Mostly is going to be monetary policy. During an economic expansion where the Fed had previously had lower interest rates, let's say they're trying to lower interest rates to stimulate the economy during, let's say, a stage 1 going into a stage 2. During a stage 4, what we tend to see is that rising interest rates, because now they're trying to kind of battle inflation. Now, when we're looking at a normal cycle, we have these normal kind of inflationary, deflationary stages within this. But it's not to be confused with the longer term inflationary cycles that we saw, let's say, during the mid to late 70s and early 80s. Those tend to be extreme. And the same would be true, of course, during the mid to early 2000s. We actually witnessed deflationary pressures within the market itself. So at this stage, when you see, for instance, that over the course of the past 3, 6, and 12 months, bond prices are actually down. And there are going to be instances where maybe the longer term trend over the past 12 months is up, over the last 6 months is up, but the last 3 months is down. You can have a situation where you're really kind of in the longer term in a stage 3, but in the short term, you're in a stage 4, which is part of the reason why I like to see this, because as the cycle unfolds, sometimes you get this type of alignment and it's like, okay, yeah, this is some evidence to suggest that not only should I anticipate lower bond prices and higher interest rates, but eventually what I should be considering is that the bull market in the stocks might actually be coming towards an end. And in the studies, courtesy of John Murphy, who wrote several books, one of which was Intermarket Analysis, in that he explains that bonds typically lead the market, or I should say the economic top, by about 27 months on average. They did this study, and granted, it was only 8 cycles, so it's not a huge statistical sample, but from 1948 going up to the mid 90s in this research report, they had 8 different cycles where they identified that bonds basically led that economic top by about 27 months. Stocks led that economic top by about 7 to 9 months, and commodities generally only by about 2 months.
Oh, hold on. When you say led that, so are you saying that if we see that drop in bond prices, a surge in bond yields, that is a 27-month kind of lead time for the market correction?
That could be
that's 2 years.
I know which is a long time,
Yep.
and I think often that will actually catch people off guard. But that is the suggestion, and of course that can vary as cycles typically do. But this is what I was referring to here when we're in stage 4. So this has a lot of implications to it, because from a strategic standpoint, if we're at a stage 4, then that means when I go to look at the charts for various bonds, and in particular 30-year and 10-year 30-year bond and 10-year notes, I should expect to see that those are actually in downtrend. So from a tactical standpoint, I might actually consider opportunities to short bonds. And looking for long opportunities, I might still consider long opportunities in stocks, but know that if we do move to a stage 5, we're probably going to see a top in stocks. So the allocation to stocks might be reduced for new opportunities. Existing opportunities, let's say that you've held throughout a majority of the bull market, you're trailing stops, you're considering selling call options against those, possibly even doing collars to protect the profits that you've built in. And then, of course, commodities and commodity related items, because this is generally referring to, your physical commodities. Of course, you can go and trade metals, energy, softs, grains, etc. But there's also stocks within the stock market itself that are in, let's say, materials sector that can still perform well, even going into a market top and even post market top, much like what we saw back in, let's say, 2007 through 2008. Because the stock market topped out there in October of 2007, yet we still saw many different sectors, energy and materials, actually continue to perform well.
So I mean, in looking at this chart here, I think at this point everyone's just like, okay, well, when's stage 5, right? It's like the ones that matter, I think, the most are stage 5 and stage 2, because those represent those kind of turning points overall for the markets. And if you mentioned there's a kind of a 27-month lag time, I would contend that we are already in quite a bit of a lead time there. For example, I've got TLT, and we can see that TLT just been selling off ever since September of last year. So we got a few months out of that 27 already taken out. Maybe we're at 23, or maybe less than that, probably like 18, 17 months left on it. But looking out at that turning point, what sort of things are you looking at that will confirm to you that we've gotten that stage 5, and now all of a sudden, okay, here we go. Let's look at aggressively shorting this market, or just getting out of our long positions altogether.
Right. So, in first thing is that, like with the bond market here, one of the interesting things that has occurred is that this kind of final major high in what I'll refer to as the secular bull market. Here, this is a long-term chart of interest rates, which is going to have an inverse relationship to bonds. But this is going back to 1977, right? And when you just take this is just a rough trend line here, but you can obviously see that the downtrend since 1981, that was terminated back in the spring of 2022.
Right.
So the implications here is that the entire paradigm within the bond market over the course of the last 40 plus years is changing. And it carries with it a great deal of implications, especially in terms of inflation from a longer term perspective. So going back to what we're talking about here, when we take a look at what's been happening here with bonds, like bonds have actually been in this bear market longer term since the spring of 2020. And we did see that we had a slight recovery here. And I was looking for the reversal. We actually had a situation where you had an inverse head and shoulders pattern that was developing. We actually broke the neckline going back into July, but what never materialized was a close above some of these prior swing highs. And so going into October, we actually had a break of this uptrend, and now the implication here is that we're moving into more of an impulsive phase, which would actually suggest that we could see bond prices get down to, for instance, like 99, 92, possibly even 89. So
which would push that 30-year up to 5.5%.
Very easily, actually, because when you take a look, this is the interest rate here for the 30-year. My targets currently are around 6.25% to 6.5%.
Wow.
So that obviously carries with it a bunch of implications, especially for real estate. But going to the equity side of the equation, right? If this is suggesting now that we're in a stage 4, what would confirm for me that we're moving into a stage 5 would be the break of some of the longer term trends that we actually see here. Now, what is kind of interesting about the market structure here, the S&P currently, is that the major swing low on the monthly chart is all the way down here at 49.55, and that's a considerable decline before we even confirm a longer term break. In the long term trend, which has basically been in place since October 2022. That's the current uptrend that we're dealing with. So we would need to see a decline from current levels of about 15%. And even then, what is kind of intriguing to me, and I'm going to switch this out to a logarithmic chart, you can see that the longer term trend from 2009 connecting up through 2020, that's still in place. And we would have to see a decline of nearly 50% from the highs in November, December in order to just terminate that long-term trend. Yeah. So, when we say that we're going into potentially a stage 5, we have to take into consideration that this is not a late 60s through early 80s or even first decade of the 2000s kind of secular bear market. Still, we are in a secular bull market. So the declines that we could see could be anywhere between like 15 to 20%, which is, it's sizable, but it's also not a 50% decline. But I think the caveat there is really, what happens with inflation? Do we actually see that inflation continues to expand the way that it did during the late 70s? Because, I know you and I, we've talked about this before, where there were 3 kind of distinct stages before inflation really kind of came out of control, if you will.
Yep. I got to share with the viewers, I love this. So I think Scott and I would make a great Oh, you took it away? You can leave it there. It's fine.
I'm so sorry.
No, it's okay. It's perfect.
Yeah, I just hit the wrong button there.
No, it's so good.
Sorry about that.
So Scott and I guess, would be the 2025 version of the Odd Couple. So if you notice Scott's charts, I mean, he's got so much stuff on it. And honestly, I'm a believer that the more you look at price, the more you study charts, the more they talk to you. And if this was talking to you, this is a full-on conversation that Scott is having with his charts. And then you look over at my chart, I'm a minimalist. I've got like 3 lines in my chart and this is the exact same time frame, exact same duration. I could just put them up side by side. It kind of cracks me up. Thank you for the entertainment. That's great. But, look, as someone who studies these things, all of this has relevance for you in helping you forecast and anticipate where things are going. And bottom line, it's trades that you're going to be making and acting on. So I don't mean to be making fun of you. I just think it's entertaining.
No, and not at all. I mean, trust me, I take no offense to this, because if I were to sit, for instance, in a PM's office at some institution, whether it's a hedge fund or a mutual fund, and just kind of presented my technical view of the market, they would probably get a chuckle out of it. But, like when I made the forecast of, prices, coming up to that 6,100 level roughly, that forecast began from back in November of 2022, right? And it just so happens that in this particular instance, we achieved that level. I mean, we literally missed it by like maybe 5 points, which,
Nailed it.
for a 2 year plus forecast, to be off by 5 points on a 6,000
You should get a trophy.
point
I mean, that's
product.
incredible.
Yeah, absolutely. And what was funny is that it was all based on the measurement of the distance from the COVID lows going up into the market highs there in January 2022.
Yeah.
And somebody might look at that and be like, dude, how is it possible that the market could actually do the same thing as what it did before? The environmental conditions are completely different. They're not dumping as much money into the market. They're tightening interest rates. And there's all these negative arguments about the market, yet it still did it. Right. Yeah. And so to your point, what I look at it tells a story. And, I'm a big believer that the market is cyclical. There's only 3 trend directions, up, down, and sideways. And there's always going to be 2 phases, impulse and correction. And so it's incumbent upon me to identify what is the current trend, where would that trend continue, where would that trend terminate. And as we see the continuation, as we see the termination, would we be moving into an impulsive phase? Would we be moving into a corrective phase? How large were the prior impulse and corrective phases? And what are the various degrees of corrections and impulses? Because, obviously you can have shorter term trends that present themselves as they're building the longer term trends. And sometimes, especially if you're only operating down on lower time frames, it's all too easy to get lost in the short term, which is pretty much why whenever I do this, I'm always looking at monthly charts, even going back to, the 1970s.
Yeah. I speak to this quite, you need to keep it right there. It's perfect. So
okay.
I speak to this quite a bit with others on, financial markets. And part of me looks at that fall from 2000 to 2003. That's historic. I mean, literally, collegiate textbooks around the world are talking about the dot-com bubble. That was 50% decline. You look at the next drop from 2007 to 2009, that was 57% decline. That's this apocalyptic financial crisis that's the worst thing since the Great Depression. And each of those was preceded by a pretty significant market rally. If I look to the right of that 2009 drop, we have this monumental, just unbelievable market rally that's happened. And my gut tells me that we're going to see this 50+% break of this market at some point in time. Does this move at all concern you because it is such an outlier statistically versus historical data?
So when I look at this, and I have this, I try to remind people of this constantly whenever I'm in the stock XLT or whenever I do the monthly market overviews. When these yellow rectangular areas here, these are secular bear markets, right? And when you look at the period in between those, these are typically referred to as secular bull markets. So when you're looking at the duration here of the expansion of that secular bull market, that was apologies for the label color here, but that was 234 months.
Yeah.
Right. So we're talking almost 20 years.
Yeah.
Right. Mm-hmm. And when we take a look at where we are currently, that's going into June. Let's bring us here to December. That's 190 months. Right. So from a time forecast, because a lot of what I focus on is price forecasting. Time forecasting for me, I find to be much more challenging. But
agreed.
When you look at the last expansion that we had, is it really right now as much of an outlier? It's like we did see this expansion back in the 80s going to the early 2000s. There it was 234 months. Now what my attention would be focusing on here is that, if the last one was 234 months and we're 190 months into that, then maybe we only have another 40 months left before we see the next secular bear market actually begin. And so, we're talking about 3.5 years roughly, to where we could see this longer term bull market that's been in place since 2009 actually terminate.
Yeah.
And actually go into some sort of, either consolidation sideways like this, or worse, we actually see, and it's difficult to visualize here. They kind of modified the historical charts going back to 1871, but this spot right here, that's the Great Depression,
Right.
Back in 1929, going in through 32. So that was an 80% decline. Even and here's kind of the funny part. Like, what if the market did go down by 80%? Like, what would that look like? An 80% decline from current levels would actually bring us back to pretty much where we broke out from back in 2013.
Yeah.
Not that I would want to see that, because obviously the implications, not just from a market standpoint, but at a human level, would be super negative, right? I mean, I don't have the vocabulary to explain right now how bad it would be, because nobody in our generation that is alive currently has probably gone through that.
Yeah.
Right.
Well, so, I mean, look, everybody's talking about AI, and you wonder in your mind. I'm kind of running through like what could possibly cause such a colossal shift and downfall in the markets, and they're saying 2 to 3 years we could have full robotics everywhere, and it kind of could line up there. I mean, who knows? It's all the future.
Yeah. So I think for that type of market forecasting, looking at major shifts in technology industry. Looking at major shifts in population, I don't follow it to the level to where I could present it like a TED Talk, for instance. But
I think you could. Come on, we got faith in you. I'll get you on TED Talks. Come on, let's make it happen.
But demographically, if you think about it, baby boomers are reaching a stage in their life where in the next, I would say 10 to 15 years, a majority of them will have passed on. And with that, you have a generation of baby boomers who really did, try to save massive amounts of money. And so, going back into the early 2000s, there was a lot of talk about transfer of wealth from that generation to the next. But we see the situation where baby boomers, especially because of the inflationary environment that we're in, they are not going to have as much money passing on to, let's say, Gen X or Gen Z or the millennials as what you may have otherwise expected 20 years ago. In addition to that, the birth rates in the U.S. are finally starting to decline. And not only here in the U.S., but globally.
Globally, yeah. Elon Musk won't shut up about it.
Yeah. And so this is something that could actually play into the market from a longer term perspective, because if you simply don't have as much money circulating in the market as what you used to, you don't have the employment base that you used to, all of those 401k contributions that go into all of these index funds that support this market, where's it going to come from?
Scary stuff. Well, Big Eb nailed it perfectly.
On that note,
Big Eb says, got it. Sell positions in 2027 and short everything. Thanks, Scott. I love it. That's good. All right. Well, let's see. I'm going to try to keep us moving on here because there's a whole bunch of things. Don't worry, Big Eb. We'll get to his forecast for 2025. So in going through your typical, we've talked about bonds. I guess I want to keep asking here just because it is of interest to me. We've seen these bond yields increase. Obviously, they've been surging recently and really starting to get some legs underneath them. I can bring up the charts here for those of you who'd like to see it. Let me bring up that 10-year. 10-year right now at 4.794, coming right back up towards that 5% mark that you see on the monthly that we hit back in October of 2023. But other than that, you got to go all the way back into 2007 before we see yields that were as high as they are for the 10-year. What do you see as the catalyst to continue pushing these 10-years? Is it the colossal amount of debt and the reissuance of bonds? Is it just uncertainty about the economy? What sort of things do you see driving this yield higher?
This is pure speculation on my part, but I do think that things are going to come home to roost.
Yeah.
Obviously, we have a new administration that is going to be coming into office just next week. So a lot of their policies could have a serious influence on what happens not only in the equity but also the bond market. If we do see that they implement tariffs on the scale that they're suggesting, that can play into the inflationary environment. And it would be very interesting to actually see how that impacts the US dollar, because the dollar's actually been moving up, which, if you think about it from a bond perspective, strong dollar, higher interest rates indicates that foreign money could actually still be coming in and purchasing US bonds, because they're getting the yields
Right.
in order to potentially offset the risk of the ballooning or continuing to grow deficit.
Yeah, and and part of the theory I have there as well is, if I'm a, I don't know, let's make it up, I'm a European citizen and my yield is nowhere near what I can get with U.S. government bonds, I would be taking my euros. I'd have to purchase dollars, convert that currency, which drives the dollar up, and then I would take that and I would go and buy these bonds to get the better yield, and that could further cause. So I think the higher our yield goes, the more likely that dollar index is going to be going up as more people trying to convert their currencies to dollars, buy the bonds, which could have an even more profound effect on our markets.
Agreed. I don't know if you guys are still seeing the charts there, but this is the series of charts that I look at. Again, I tend to look at longer term charts, right? Monthly charts going back as far as I can. And what you see here in the top, this is the dollar index, and the dollar index finally broke out of this area of consolidation. Like it had been in this range for nearly 2 years. And we finally managed to break out of that area back in December. And the implications here is that, when you look at the measured move from December 2020 going into that high there in 2022 and project that from the lows here in July of 23, that gives us a measured move target at $1.25. Which is, it's like, wow, I think is the right response, because if the dollar actually gets to $1.25, then, you would most likely witness a situation where other foreign currencies, sorry for all the back and forth here,
okay.
Other foreign currencies are going to be trading at decade lows.
Historic lows, yeah.
Yeah, this is going back into 2000. And granted, this is a continuous contract for the euro. But we already have a situation where the longer term trend here for the euro is to the downside. And, that entire period of consolidation that I just referred to in the dollar index is basically a corrective phase here for the euro. And we finally topped out there in September. And you can see some of the measured move targets that I have here puts the euro down around 85 to about 83, which again would be levels that we haven't seen since 2001.
That's when I moved to Europe. And I'll tell you
exactly.
what. I'll tell you what. If that happens, I'll take dollars. I'll move to Europe and I will buy real estate at 0.83 to the dollar, because everything is going to have these ebbs and flows, right? It's like the dollar might get down. I think it was 0.86 when I went to Europe. We get down to 0.83. I can buy a lot more land over there, and then you may get the appreciation of the euro once it comes back, because it will, just nature of the beast, and the appreciation of housing prices. So double whammy. Oh, you're getting all excited. I can now travel with this, super strong dollar and go to all these different countries, Scott. I love it.
You're welcome. The British pound here, I've got targets down around 95 to 90. We talked about the Japanese yen before. The Japanese yen, this one right here is the one that kind of scares me the most, but I've got targets in around 47 on that.
Wow.
Which is significantly
yeah, geez, I'm maybe I'll move to Japan.
I heard Tokyo's pretty nice.
Yeah, I heard.
Yeah.
Wow. All right, this is a little bit of a curveball, and I apologize for it, but you are hearing more and more about digital assets, and we are hearing about Trump talking about potential reserve currency, strategic reserve for Bitcoin. Have you added that to your repertoire? I guess you could throw it in the commodity category, because that's what it's classified according to the CFTC. Are you does Bitcoin impact you in any way, or do you look at that as kind of tying into commodities and dollars and currencies?
I still haven't.
Okay. Some point you will next year. Next year.
And at this point, I mean, it is because I know your background with it. I mean, it's like you might be wondering, why not, dude? What is wrong?
No, it's okay.
And trust me, there were conversations that I had back in 2012 with some colleagues that I worked with here in Dallas that, kind of made me wish that I just threw in, $5,000 or $10,000 back in the day. It's like who wouldn't, right? But I do think that there's significant argument, stronger argument from an alternative investment standpoint to consider having Bitcoin.
Mm-hmm.
Now, of course, me saying this could mean that we're probably at the top in Bitcoin.
You want to polish my shoes too?
Exactly. And forgive me, I don't know if this is actually the like which of these you
They're
use.
all the same. Remember, it's like Forex. They're all just different exchanges that are all going to be relatively similar. So
yeah.
anyway.
So the one that I have been looking at is the Coinbase one. So I don't know if there's going to be.
It only takes you back to 2015. The other one Bitfinex takes you back to 2012. So it's not like it's a big difference, but.
So when I look at this chart, right, and I've demonstrated this in the GPS sessions before, because I've gotten a lot of requests like, hey, can you look at Bitcoin? I don't like to look at Bitcoin. I think that there's still a lot of speculation in it, and being that it's not necessarily backed by a government at this stage or centralized on an exchange, kind of makes me a little hesitant. But when I go through and I take a look at this, right, obviously the longer term trend is to the upside, and kind of going back to what I was saying earlier, I always look at, one, where's the trend direction? Two, where would the continuation or the termination be? Three, what phase is it? And of course, four, how large were the prior phases? And so when I come out here and look at, just some very simple measured moves, this is your impulsive phase that you had from 2018, 2019 going through 2021. And you can see that we've already surpassed 100%. Yeah. And as a matter of fact, we got pretty close to that 141.42. Now, if this trend continues here, your next target on this would be the 161.8 extension, which would put Bitcoin in around 122,000. So in taking a look at this again, where would the continuation be? It would be above the December highs. In the short term, the termination of the current impulse that we're in would be below 49,000. And when you consider like how far that would have to drop in order to terminate that, I mean, that is just, it's staggering, because even from its current level, that would be nearly a 50% decline in value just to terminate that trend. And I would hate to look at this and be like, all right, well, I'm going to buy here and put my stop down here. No, that's not the way that would work. It's like if we certainly start to take out these lows here around 89,000, or even this low here from back in November and around that 89,372, I would say that you're probably going to witness a little more selling pressure here. And there's no guarantee that this market would actually decline as far as what it did back here in 2021 through 2022. And I haven't done the intermarket analysis to see like what are the relationships to bonds, right? But a 100% extension here would bring Bitcoin back down to around 54. You've got 112 extension here at about 47,000. So would it be out of the realm of possibility to see that go down to that level? Not necessarily. Yeah. But
do the same extension analysis from the sell-off in 2017, because what's interesting is those lines you've got coming out. Yeah, the lines you have coming off those lows. Those are 3 years. Both of them are like exactly 3 years, and there's a 4-year cycle. Maybe I'll send you the video. I did a video on this thing because I can't figure out why, but it's perfect 4-year cycle, and that cycle actually ends in November of this year, so it should be very
interesting.
Yeah, it is really interesting. And it's like, it's never failed. That's the part that's interesting. It's like, it's never failed. I'm like, uh-oh. And at the end of that 4-year cycle, by the way, it drops 70 to 85%, which is like, oh, crap. But my target's 250, so I got a little bit different target than you, but that's okay.
Yeah. But, in taking a look at the 100% extension of that 2017 decline, forecasted or projected from that 108,000 It's already it's already met that measurement and actually exceeded it just yesterday. Actually, this is a daily chart here. You can see yesterday there was a lot of volatility in Bitcoin.
Big time.
Yesterday, but you can see it actually traded down below that 91,000 level and actually recovered here over the last couple of sessions pretty nicely.
Yeah.
So, but from a technical standpoint and from a short term standpoint, like the thing that I would look at here is the fact that you do have a short term trend here that has developed to the downside, breaking that and actually making some higher highs and higher lows would be pretty key here in order to continue that bull market to the upside. So not only terminating this downtrend, but actually seeing higher lows, higher highs develop. And at this stage, in order to make a higher high, you've got to get above 102,000.
Yep.
So at this stage, in the short term, I would say that crypto is in a little bit of a correction. If you're a fan of the movie The Big Short, it's just a little gully.
Just a little gully. Nice. All right, last one we haven't really touched on. I don't want to go too long, but what about, I guess, our last market segment here? So I actually had some slides. I was going to do commodities. There we go. So I've got my, I know this is going to impact you near and dear to your heart, but live cattle is like historic highs. Just keeps going and going and going. Anything that stands out in that commodity, because we talk about commodities impacting inflation, but a lot of them have been selling off nicely and seeing a nice pullback in prices, where others have been absolutely soaring.
So let me bring up a list here because let's see. Let me got my futures expanded list. I don't always go into the agricultural, the meat space. Right. If I'm not mistaken, lean cattle is LC.
Yep.
Live cattle, rather. Yep. Here we go. All right. So live cattle, but where is my? That is not correct. Let's see here.
It should be LC.
I'll just type in cattle here. There we go. So lean cattle and okay. So in taking a look at this, from an inflationary standpoint, right? It's not just crude oil that's going to impact individuals. That's obviously a big one, but food prices.
Yep.
Right.
Big
so time. Looking at things like lean cattle, or in this case, live cattle, looking at coffee, you'll see that some of these have actually.
Casey.
I'm sorry. Oh, that's right. KC. Man. Appreciate that.
There you go.
Okay. You can see that coffee is trading at levels that we haven't seen since 1977. Cocoa.
Yeah, cocoa is really just like, wow.
Yeah. There's a guy that I follow on LinkedIn who is a cocoa trader for what's a big agricultural company? It starts with the C. Cargill. Right. And he talks about this pretty often, but cocoa has just been.
And this is a monthly chart for the viewers out there. Just understand, right. It was trading at $2 in 2022, and right. It hit a high of 13. I mean, your candy bar. It's crazy because I walk by the grocery store shelves and I look and I'm like, are you kidding me? A Snickers bar is like $3. I remember when they were 37 cents. Like just
right.
Insane.
Right. Let's see here. Where's sugar at right now? So when looking at these, it's kind of crazy. Like sugar's not too bad. You start to get into some of the grains, like corn here. Corn came off of its highs back in 2022, but you can see we've actually started to build a bit of a bottom here, right? So taking out some of these highs from back in May could be fairly significant in terms of development. Same thing here with soybeans. Have had a pretty nice correction.
Check out OJ.
The last couple of years.
Check out OJ's jaw dropping. Well, I don't even drink it anymore because it's just sugar water.
Orange juice.
Oh, you don't.
It's crazy.
I just use this. I use OJ1. Yeah, there you go.
Oh yeah.
Gotta love it,
right?
Wow. I mean, you're like, what is this, NVIDIA?
Lewis and Winthorpe, you know?
Yeah,
Like, come
Liz
on.
says it looks like a meme stock. It totally does. I
Yeah,
swear it looks like Nvidia or Bitcoin's price chart, but no, this is OJ. It's nuts.
right. Yeah. Yeah, I was trying to find a chart for eggs the other day, but I don't think that that's
Yeah, the butter and eggs got
anymore.
absorbed a long time
Yep.
ago.
Yeah, long time ago.
All right.
So, but yeah, I mean, certainly from a food standpoint, I mean, inflationary for sure.
Yeah.
You know, um, and it will be interesting to see what happens here with corn, wheat, and soybeans, because obviously, you know, very very heavily used commodities within food.
Right.
So,
Well, it's interesting. I was speaking in Los Angeles yesterday at our center, and we talked about the impacts of the fires and kind of what happens. And you look at the cost of living in Southern California. In my opinion, is going to go up significantly because of housing prices are going to surge to the upside because all these people looking to buy a home and what they get their insurance claims, they need a place to stay. Rents are going to be going up. Insurance is going to be going up, and it's be interesting to see over time how even little things like that can impact an economy. We are the fifth largest economy in the world out here in California, and it
right.
may end up taking a lot of people out of Cali. I could see some people going, I'm done with this. I'm fed up with it. I'm going to move somewhere else and get 5 times as much for the same amount of money. It's be interesting.
There was an interesting map that I saw the other day that was showing the net change in terms of population in each of the states. Texas and Florida having a large growth, but you take a look at where that was coming from, and it was New York, California, and Illinois. Those, I think those were the 3 states that had like the largest decline in overall population. And I think you're right. It's like events like this, they're not new, but the more people it impacts, the more chances there are that somebody's going to make a decision that maybe it's time for us to really kind of move, because from an economic standpoint, it's assuming that you actually have, one, you're either retired, or 2, you have the ability to work remotely. Why do I want to rebuild in a place where I'm going to have to pay for everything almost out of pocket, because, what insurance company is going to, help me cover my $11 million home that I just lost?
They're not, it's interesting when you hear more and more people talk about it. There's a lot of talk from, I hate to say celebrities, that at some point this inability to manage the state effectively could push this into a turn California red, and who knows? That one of the things that people were mumbling about here is that in order to get your homes rebuilt, it's going to take forever because the permit process is going to be impossibly slow. It typically is. Newsom just jumped ahead of that and said, "No, I'm fast tracking all permits to get this stuff done." So there will be some things, but certainly the impacts of an event like what's going on out in Southern California could have a huge impact on a country and economy.
Yes, and the other thing too, just kind of going back to the investment side of things, is you should probably keep a close eye on municipal bonds for California. Californians aren't the only ones that actually buy these things, but it can actually have kind of a ripple effect within the bond market itself.
Yeah.
So,
all right, bring up your SPX. It's forecast time. Let's get you on our list.
Yeah.
Let's get you on that list.
On the SPX, I think this is going to be pretty simple here for me. I am expecting a down year.
Oh.
Again, don't know what the catalyst is going to be. But when we take a look at what's happened here over the course of the past 2 years, we can't deny that we've been in a bull market for the last 2 years. There's no alternative truth to this. And we did manage to reach a major measured move completion here. Now, of course, could the market continue to trade higher? Absolutely. And this goes back to what I was saying earlier, right? So seeing the markets trade back out above the highs from December at that, let's just call it 6,100 level. Then I do have some other upside targets there at 6,300 to 6,500. There's even some targets out there in and around 7,700,
wow,
which would be very interesting. On the other hand, if we actually take out this low here, and when I say take out, I don't mean just like, oh yeah, we traded down below this. No, I would want to see that if that's a weekly swing low, we actually get a monthly close down below that level, which would be 56.96. That's the last swing low that we had on the weekly chart going into this high. So if we do see that that close down below that 56.96 on a monthly basis, I am expecting a little bit more of a major correction. And so the last area that I was really kind of looking at was bringing us back down to around that 4,800 level, basically where we broke out from going back into January of 2024. So that would be about a 15 to 20% decline overall.
So what was your number? I'm going to put you on the list over here.
Yeah. So the corrective level here, 48.18. So let's just call it 4,800.
So on that note, since you have the chart there, you did draw these kind of longer term trend lines, and obviously you've got that trend line that starts in right there. Yep. Does that doesn't sway, because you're basically saying we're going to break through that one,
right? So if we in my mind, the way that it works is that if we break this trend line, that means that the impulse phase that we've basically been in from the lows here in 2022 to these highs here in 2024, that's terminated. And the corrective phase that preceded it was here during the 2022 basically. So in measuring that, this was a 27% decline. So we could see obviously a similar percentage decline, but in terms of just price, that was a 1,300 point decline, and projecting that roughly from this area would actually bring us down to about 4,400. But we have this area where, the market tends to have old resistance that can become new support. And we do have some demand zones down around that 4,700 level. So I'm more inclined to watch that 4,800 level. But otherwise, again, if we do, get down to these areas, I wouldn't be surprised to see a retest of the lows back in October 2022.
Oh man, boy. Let me put you. You're on the list. You're actually the lowest. Wow, this is interesting. Let's see. I'm going to put you on the list. You are the lowest forecast so far. We have
That's
Dave.
Fun.
We have Dave Cordell. Dave Cordell has his 49.31, and you're at 4,800. Woo, Nelly, that'd be a decline of about 14% for the year. And again, it's just an opinion,
Yeah.
And fine. I think, personally, I think if we got down to those levels, down about 14% to 4,800, I'd be looking to buy myself. Because the longer term picture is still up, but you never know.
Exactly. And, I forget which market wizard it was, but to quote them, strong opinions weakly held.
Yeah,
right?
Exactly.
It's important to remember that this is a fluid environment. And, as I pointed out here, I've got two key levels, one on the upside, one on the downside, that if we break those, then I'll expect the market to move higher. So it becomes a matter of reaction more so than it is prediction. Right.
Yeah, totally agree. And last one, since this is a new one, just to bring up Bitcoin, because we're doing this just for fun now in Bitcoin, and what's your thoughts on where we'll end the year on Bitcoin?
Yeah, so I think kind of going back to what we were looking at there on Bitcoin, there. So I did we went through that process here of kind of drawing out the what TradingView here calls the path, right? So, anybody watching this, basically, first thing I do is just look at the major market structure, okay? But then you have to take into consideration also the market structure that is currently building the most recent impulse phase, and that can give you kind of smaller measurements that are within here. As we demonstrated a little bit ago, we already have kind of exceeded some of these measure move targets from.
Can everybody at home smell this? Smelling like Elliott Wave over here. I'm smelling Elliott Wave.
So in looking at where we are here, okay, you can see that we have kind of this move that developed from 2020 or September 23 up to March of 23. And so projecting that from this low here in August, again, you're already kind of exceeding that equal measure move. So I would say that we are kind of long in the tooth here. In looking at areas of confluence, I don't really see anything that is kind of overlaying too much until you get up here to about that 140, 146, 147,000 area. It's kind of interesting that you do have measurements from two completely different areas that are actually lining up there.
Right.
So from a psychological standpoint, I think that 146,000, let's just call it 150,000, would actually be kind of a key level for Bitcoin. If we do see a retracement here, again, within the context of this most recent impulsive phase, you do have this minor correction that took place, and that brings us back down to around 84,000 on Bitcoin. But again, be mindful of where you have prior highs that have developed,
right?
Because you can find some support in those areas. And if we take a closer look in and around the spot here, chances are you're going to have some demand down on the daily chart in that area.
Yeah.
So
which one do you want me to put you in for? It was 80 something and 140.
Yeah, I would say that we're probably going to see the upside here before we see the downside. Okay. So I'm gonna throw that target out there at 146,000.
Got it. You're in the books at 146. Prizes awaiting if you win.
I'm still waiting on my shot glasses for last year.
Did you win last year? You didn't win last year.
No, I don't know. I was so close. Actually, you know what it was? When I went back and I listened to the recording, so I gave the forecast that we were going to hit the 6,100 and then see the retracement. I thought we would have hit 6,100 earlier in the year and then had the retracement back down to the levels that I'm looking at now.
Yeah.
But that obviously didn't come to fruition. So. I will tip my hat to whoever was closest to the pen.
I can't remember who won it last year, but yeah, it was a valiant effort. I didn't mean to take a full hour here for you, but real quick, I know you got a lot of fans that watch this program and already are Trading Academy graduates, but for those who may not be, where can they find you? What sort of things you teach in?
Yeah, I don't really have like a social media presence at all. So within the world of Trading Academy, my regular routine is Monday, Wednesday, Friday. You can hear me do the daily market overview. Mondays, I do the weekly market overview as well. Once a month. Generally, it's the first, sometimes second Wednesday of the month. It just depends on if there's a holiday in there or anything like that. I do the monthly market overview, and then every Monday, assuming no market holiday, I host the Stock XLT. So
there you go.
So I'm out there pretty often.
You are. He's always doing something good. I'm still thinking we got to get you more active on social media or get you.
No.
Yeah, come on.
No, I was out there for years, but it's just, I don't know. It's too toxic of an environment. It doesn't bode well for me. It just makes me angry.
You gotta ignore all the stuff.
Oh no, I know, but it's just. So
it's funny because like I manage the Trading Academy YouTube channel, and it's like I'll post a video, which is my goal is, okay, I'm conveying the information for the week. Here's what's happening, and then you get someone just chimes in the chat like, you're a loser, you're a POS scumbag, blah blah, and you just go, really? I'm not soliciting anything. I'm just giving information. So, but you just block them. You just remove those people from the list. Yeah, crazy stuff.
All right.
So Les won it last year. I thought I was talking about the year before, but yeah, Les Gold won it. And it was actually on the high side. It was definitely on the high side of our forecast. But all right, Scott, I appreciate you coming on. I know you're a busy man and you got a bunch of stuff going on. So thank you for your forecast. I look forward to having you back on here soon, and maybe we'll go out to some of these Traders Expo. I was talking to Larry. Sounds like you're kind of up for it.
I so long as you're there and you can kind of hold my hand through the process, because as much as I enjoy being around people, that spotlight sometimes it's a little too much for me.
Yeah, well, I think I speak for everybody here. You're one of those people who maybe you're uncomfortable in the spotlight, but as soon as you start talking about markets, everyone respects you, and it really has values your opinion. So I appreciate you coming on, as does my group here today. So thank you guys so much. I appreciate it, and Scott, I will talk to you soon.
All right, sounds great. Take care.
All right, take care. Guys, that was Scott McCormick. You can find out more information about Scott at tradingacademy.com. He's one of our top instructors over there. 5581 was the number. Let me bring it up here just so I can show you guys. So here's the table. and that's the number that I had. If I'm mistaken, then that would change everything. Again, that was off the SPX. You can see the number right there in the middle of the screen. That's the number we're using, 5581.66. But let me just go back to the daily. You guys are calling me out on this already. Great. Here come the hate comments in the chat down below. Merlin's a PO. And I will put a horizontal line on the opening of, actually on the closing of December 31st, which is right there. It says horizontal line, which is 5581.62. Not doing it from the open. It's because the overall change will be measured from the final closing day of the year. So yes, 58. Wow. Interesting. 58. Why? Yeah, you're right. Hold on a second. Hold up. Hey. No, you look here on SPX, and it's 5881. Yeah, let me fix that. It's 5881. I guess I had dyslexia here. That is, that'd be very different. Yeah, significantly different. So it's actually 5881 is the number there. I don't know why I typed in 5581. Thanks for calling me out on that one. You guys called me out on it. Ay. Uh-oh, what happened? Yeah, I don't know. I could have sworn that this is 5581, but it's actually 5881. Maybe I had dyslexia. Yeah, I see it. Maybe I had a moment. I had a senior moment, apparently. Okay, now here's the question. Now, does that mean that I allow you to change? So here's the problem. Now that Scott has given his number, a lot of you are like, uh-oh, I want to change mine. No. You stick to your opinion. Don't let someone's opinion sway you. Don't let someone's opinion sway you. It is interesting to get their opinion, but I don't know whether I let it change. But I will change the SPX original, which changes these percentages here. So I'll do that tonight. All right, I'm way late, and I got other things I have to take care of. So I guess we won't have much of a chance to look at today's markets. As far as gains and losses, the only thing that really kind of strikes me is what's been going on with crude oil and that big moving to the upside. Yeah, surprise there. Bitcoin, is really just kind of boring and dead right now. I mean, granted, there's big volatility, but it really isn't doing anything. This 10-year is one that is of concern because it continually keeps rising. We'll talk about that more in depth tomorrow. You've got gold. While it has risen, it's still kind of just going sideways. Dollar index is ripping, as we talked about today. And then you had your Russell 2000, which this one had an interesting hammer formation form yesterday, and Chipotle. I actually did make some Chipotle trades, but we'll see if that one pans out. I actually bought directional calls, took a flyer on Chipotle for a Friday close, but we'll see if that works out. All right, so for tomorrow, we are going to have Colin Teddards on the program. You guys might remember Colin. He does the Investors Video channel, which I think he sold it to someone, and now he's back. It was funny because the first time I had him on, it was rough. It was like a little outside garage thing, and wasn't really. It was great content. And this guy has just gotten better and better and better and better. And if you don't follow him on X, you should. He just got back from the CES talking about all the technological innovations. He's one of those guys that likes to dig into all the numbers, which I don't like to dig into financials and all that stuff. So we will get his thoughts on these markets for 2025. If you have something specific you want me to ask Colin for tomorrow, send it on in at tradermerlin@gmail.com. You got it on your screen here, and I'll bring it up with him on tomorrow's show. Should be a pretty exciting one with Colin Teddards of Investor Videos on YouTube. So thank you guys so much. Hope you enjoyed it. I love having Scott McCormick and your interaction with him today. I'll see you guys tomorrow with Colin Teddards. Take care.